This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 181. 5 Big Myths of Classical Economics.
Well, it is a little bizarre that in the Debunking Economics podcast, we haven't devoted an episode to debunking some of the common myths about economics. Yeah, we've taken a number of them one by one over the years, but this week, let's look at 5 of the big hitters, ideas that can clearly be shown to be wrong, and yet are adopted as sacred and without question by neoclassical economists. That's today on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Okay, well, Steve, the first one, this is really the first page of the economics textbook, isn't it? We're looking at the demand curve.
Yeah.
So, I mean, the idea is as price goes up, demand falls, and that's sort of, if I was running a business and I was selling widgets, that would normally make sense, wouldn't it? That's sort of at a microeconomic level or on a business level.
Yeah, I mean, this is sort of the foundation of economics. They actually call it the law of demand. Okay,
Yeah.
Law, L-A-W, law. Quite our old mate.
So it
Paul.
can't be questioned.
Can't be questioned. But in fact, back in 1953, the year of my birth, one leading neoclassical economist called William Gorman decided to question it, not because he wanted to question it, because he could see a potential logical flaw in the argument. And that was that all the stuff they do to derive, I can't help but speak about neoclassical economists in the third person because they're not me.
Okay. They will henceforth be referred to as they.
They are always
Right.
they.
Yeah.
Okay. They teach students a little thing about what they call indifference curves to derive what they call the law of demand. These days they whack that thing at the back of the textbooks. If you actually get a copy of ManQ, and all students now grab a copy of ManQ, you'll find that advanced topics includes the indifference curve. They start assuming a demand curve in the front of the book and then bang at the very end of it. Now
Well, I remember because page 2 was, all those exemptions, wasn't it, really? So the page 1 was, this is how the demand curve works. And then page 2 is, but then we get inferior goods.
Well,
And then things can actually work the other way, right?
Yeah, that's what they call a Giffen good. As is usual from neoclassical economics, named after somebody who wasn't there when the historical event they refer to occurred, which was the potato famine. So one of the things they'll say is, well, there is an exception, and that's when the price of what you're buying is so expensive that you spend, if the price rises, you've got to abandon other stuff and buy more of the stuff you don't want to buy. So the neoclassical explanation for the potato famine. Should we go into the potato famine itself? The history?
Yeah,
okay.
yeah.
The potato famine occurred because it was actually, I think, either a French noble or a English noble with exposure to France realised that in France they have what they call the pomme de terre, the apple of the earth, and he thought this would be a great product to introduce into Ireland because the Irish, after being a tiny little event called the invasion of Ireland by the William of Orange, the third successor of the guy who threw the Spanish out of Netherlands, he's invited in to become the English king. Then there was this totally brutal invasion. Cromwell did them over as well. So this is the historical background of why the Irish aren't particularly fond of the English over time.
Well, I think most of them have got over it now, haven't they?
They've got over it now to some extent, but they're back to the potato famine. So this, when the English were the landlords of Ireland, and you had the peasants working the land, this guy realised, well, we can bring in the pomme de terre, the potato, and that will give an easy crop, easy to grow, etc., etc. And so the whole of the Irish population did adopt the potato. Of course, fish and chips, that's the ultimate English cuisine, So the potato became the common food. But of course, he brought it from one farm. And what it meant was he brought one variety of potato, one genetic variety. And of course, potatoes are root crops, so you don't actually see what's going on until you dig them up. If it was a branch crop and this had happened, it would have been obvious right from when the first growth began. So the Irish regular pastime of grow the potato, eat the potato, etc., etc. I've forgotten the potato famine occurred. It's sometime in the 1830s, I think.
Yeah, I'll take your word for it. This is one big tangent you're taking us off on here.
Yeah, but it's an important tangent. Okay, but when the Irish went to dig up the potatoes, there's what's called the potato blight. Now in France, because there were dozens of varieties of potatoes, and one thing you've got to say for the French, they enjoy their varieties of not just potatoes, but there's different types of potatoes, different types of everything in France. In Ireland, there was only this one one genetic element, and that was the one the potato blight wiped out.
Right.
So in France, the fall in food in sort of potato production, courtesy of potato blight the year, was maybe, say, 10% of the crop. In Ireland, it was almost 90%. So what then happened, that meant massive starvation, the Irish exodus, all the stuff that led to the Irish spreading out throughout the rest of the world, really happened with the potato blight. But the economic interpretation of this was simply that, well, as the price of potatoes rose because there were less of potatoes, so supply. Okay, the Irish bought more potatoes because they couldn't afford to buy other things such as pork. Okay, so they had an upward sloping demand curve, and that was supposed to be the exception. That's what students get taught at the front of the book. Back to the back of the book these days. That was actually the back of the book now was the front of the book when I did my economics. So we started with indifference curves.
Right.
And what they have is this model. They show that you have an individual with a budget constraint, and the budget constraint is basically their income, the dollars you earn. You've got the budget constraint and relative prices, and that will give you a line you can draw and say, okay, you can afford to spend all your budget on either potatoes or pork. And there's a straight line linking the two where you're spending 100% of your budget, and that's your budget line. Then you have what they call indifference curves, and what they show is a bit like a weather map. You show a map of the climate. If you look on the TV and you see a weather map these days, we see all these contours joining points of equal pressure.
Yeah.
Okay.
Your hectopascals.
Okay, hectopascals. Okay. Well, what we have is hector utilities in neoclassical theory. So they join all these points together where the combination of potatoes, lots of potatoes and very little pork at one extreme, to lots of pork and very little potato at the other extreme, shown a menu between those various combinations, you couldn't decide which one you prefer. So they call it an indifference curve. You're indifferent between whether getting lots of potatoes and a bit of pork, or lots of pork and a bit of potatoes and everything in between. And then the budget line, where that hits is a tangent and touches the highest of the indifference curves you can reach. That's the combination you buy. Then what they say is, well, now we say, let's imagine we halve the price of, or let's say double the price of potatoes. Okay, then that's going to reduce what you consume of both. Okay, so there's what they call an income effect and a substitution effect. With the increase in the price of potatoes, you can buy less potatoes and less pork. Because
I've spent more on the potatoes.
You spend more on the potatoes. So you end up, as the price rose, you spent more on potatoes, and that's supposed to be the exception to the law of demand. So that's what students learn, and they think, oh, that's sophisticated and bullshit.
Well, I mean, wouldn't I actually just say potatoes are too expensive now, I'm not going to buy any potatoes and I'll just eat pork?
Well, the thing is, you can't afford to buy enough.
Or something else.
The idea issue, this level, the so-called Giffen good, you simply can't afford to buy anything else. Right. Okay, if you don't buy the potatoes, you starve. So therefore, you buy more potatoes. That's supposed to be the sophisticated example of an exception.
So why is it bullshit?
It's bullshit because if you go back and look at what they're explaining and all that analysis is the demand of one person. Okay, the indifference curve is the tastes of a single individual. And of course, we are all individuals. To quote Monty Python, we are all individuals.
I'm not.
Oh, yeah, you are.
So this is where we get into Samuelson in the 50s, talking about America as one big happy family.
That's right, because what Gorman first realised, and Samuelson realised slightly afterwards, 53 for Gorman, 56 for Samuelson, is that this is an explanation for the demand curve of a single individual. Now, how do you get the demand curve for a whole market?
Well, you just assume that everyone behaves the same as an individual. I mean, that's what economists do.
That's what they do. But the thing is, Gorman has realised there was a logical flaw going on here, because the way they derive this idea of an individual demand curve is they say, let's imagine you've got a fixed income, no change in your income, a fixed price for one of the two goods. So let's put pork on the vertical axis and potatoes on the horizontal to work out this indifference curve. And then you rotate the curve. The fixed point remains. Your income is constant. The price of pork is constant. You're varying the price of potatoes. And then you work out, okay, given this particular price, how many potatoes will you buy? Then make them cheaper. How many will you buy, et cetera, et cetera. For most goods, when they do that, what they call the substitution effect, because pork is cheap, because potatoes are cheaper, you're going to buy more potatoes. That's going to be a positive relationship between a fall in the price and an increase in the demand. The income effect, of course, because potatoes are getting cheaper, you could afford to buy more pork and more potatoes. Okay, so that's income effect boosts both those elements. So at the micro level, they go through all the stuff on income effects and substitution effects, and they work out, that for most commodities, they show that normally you expect price to fall. If price falls, demand will rise. They then also say that the substitution effect complicates things. So if we want to see the pure law of demand, what we do, and there's a guy called John Hicks who turns up all the way through economic theory stuffing stuff up. John Hicks said, well, we can get rid of the income effect by, when we drop the price, first of all, you get a new point of tangency to a higher indifference curve, okay? So if you imagine this idea of a line going out, you've got a set of contours, and as you make one thing cheaper, the line gets flatter, and therefore the line goes to higher and higher indifference curves, a bit like higher and higher pressure levels in a set of isoquants for isobars for the weather map. He said, well, that's getting to higher indifference curves. Now, if we want to see the pure law of demand, what we have to do is get rid of the income effect. And he said the way you can do that, you start with a particular budget line and set relative prices. There's a particular indifference curve you're on. You then move the budget line out by dropping the price. That means you reach higher and higher indifference curves. What Hicks said, well, let's just imagine that we could take away the income effect of that lower price. By what we do is we simply take the new line of tangency to a higher indifference curve and bring that curve back so it just touches the previous indifference curve, the original one, at a different point. And that necessarily will mean you will have a higher demand for a lower price. That's getting rid of the income effect. I've lost you, haven't I?
Yeah, a little bit. I mean, my takeout from all of this was what seems like a very simple principle has been shown that it's too complicated to be simplified.
Yeah, and this is only stage one. So most economists are aware of this. Now, what Gorman did is say, well, when you're working with more than one individual, you have more than one budget constraint. Your budget will be different to my budget. Yeah. Okay. Your tastes will be different to my tastes.
Yeah, and they're going to be more than two, choosing between two.
But two's all you need.
Right.
Two's all you need to prove it wrong, because what you do is, when you see how a textbook does this, and Mankiw is a classic example of this, he simply says, well, we've derived a demand curve for a single individual, and here's another individual, let's just add them up horizontally. Now, what Gorman's deeper logic was to say, well, you can't do that, because when you change relative prices, you also change incomes. You may well be a potato farmer.
Yeah.
I'm a pork farmer.
Yeah.
Okay. When you change the relative price, your income changes as well. So the point of tangency moves up and down the vertical axis. And now what you're trying to do is add people horizontally when the point of tangency is no longer fixed. And you've got multiple points of tangency as well.
So there's no feedback, in other words. It's sort of, it's assuming you are transplanted from another economy. You're making money elsewhere, coming into this economy and spending it, and your income isn't changing the economy that you're living with.
That's right, but it's wrong. Yeah. Because you're actually in the same country, both in the UK doing this, so you cannot do that. Yeah. So when you do the pure mathematics properly, what Gorman finally concluded was that the demand curve, which slopes downwards for the individual, and they do what they call Hicksian compensation because of Hicks's little trick about income and substitution effects, when you do it at the aggregate level, and you therefore say you're looking with multiple commodities and multiple consumers, but two is enough. Two consumers, two goods is enough to show the fallacy. The point of tangency is changing from each of the lines. It may be that by making potatoes cheaper, I reduce the demand for potatoes because the person whose income rises doesn't like potatoes. Okay, so the ultimate solution that Gorman found he had to do was the only way to guarantee that a market demand curve produced by adding up the demands for two or more individuals, for two or more commodities, and choosing one of those commodities. The only way to guarantee that that curve actually sloped downwards was to assume that consumers have not identical tastes, but parallel tastes, okay? And secondly, those tastes don't change with income. So if you happen to like one potato for every 100 grams of pork, if your income increases by a factor of 10, you'll buy 10 potatoes.
I become a multimillionaire. I'm still on my potatoes and pork.
And on it goes. So, and he literally, I mean, I didn't actually give you this quote because I thought Samuelson's is better. Gorman finally says, because he's a pure mathematician, a good mathematician working as an economist. He's brainwashed by thinking like an economist, and this is what happened. This is what pisses me off about them. He finally said he realised that the conditions were that tastes had to be what are called Engels curves had to be parallel for all, not just for an individual. They had to be straight lines, parallel for everybody. So you might like more. I won't go into that particular complication, but it means our tastes are the same. Okay, but it also means the commodities are the same. So if you have a 1-for-10 ratio between potatoes and pork, when you're earning $100, £100 a month, you will have a 1-for-10 ratio when you're earning $1 million.
So this is the problem generally for economics, isn't it? Not just on the demand curve, but I mean just generally this idea that let's take the behaviour of one and just extrapolate from it.
And that's what they've done. So he actually said, I can virtually quote this by heart because when I first was you've got to be joking. Said the necessary and sufficient conditions above seem intuitively reasonable. They say, in effect, that an extra dollar of purchasing power will be spent the same way, no matter to whom it is given. That's not intuitively reasonable. It's fucking
crazy.
Garbage.
It is garbage. I mean, look, anyone who's been involved in marketing knows it's garbage because you spend an inordinate amount of time and effort trying to segment the market because everybody's got different behaviour. Let's look at another graph then to do with investors. So you've got the capital market line. This is the trade-off, isn't it, between the risk and return on investments, trying to get what is going to be the premium. So this is all really to do with the risk factor. So looking at the standard deviation for a particular asset and say, okay, if we move along that curve within that standard deviation, we're going to reach an optimum point where we're going to be able to maximize our return.
Given the risk we're willing to absorb.
But first and foremost, if it's a risk, it's unknown, isn't it? So isn't this actually trying to negate the idea of risk? Let's have a definitive model that's going to tell you what level of risk you can take. It's still a risk.
What you've got is uncertainty, risk being used as a proxy for uncertainty, and that's bad enough. Okay, that's outrageous, but that's what they do, and this is why Ole Peter's work right now on ergodicity economics is so important because it drives a Mack truck through that particular assumption. But the one for Sharpe is he did a similar thing that we've talked about for the demand curve for a single individual in a market and was approaching the same sort of contradiction because what he had was, I'm going to assume that an individual can borrow as much as they like at a risk-free rate and then has a portfolio of shares, expectations that individual has about shares. We have an expected return on the horizontal axis and a standard deviation for that expected return on the vertical, and you make up this cloud. Okay, and that cloud is that individual's guesses of what IBM's going to give as a return over time and the volatility of that return, what Tesla's going to give, et cetera, et cetera. He realized he had a theory for a single individual, but not a theory for everybody. So he said, I'm going to assume that everybody has the same expectations about the returns of shares and their volatility. We all agree on the expected return and the volatility for every share in the market. Now, so that means is your NAB podcast doesn't exist. Because everybody has exactly the same expectations.
No, that's right. And so there's absolutely no point in me there every day saying this is the way the markets are going to behave because it's already predetermined.
Everybody expects it.
Right, but they don't. And so doesn't that just mean that this idea is debunked itself by the mere existence of the market?
Sharpe himself actually said that in a later paper. He wrote the paper in 1964, I think, the Capital Market Line, and said, needless to say, this is something we all agree is an extreme assumption. However, it's the only way to get the result we believe in the first place. Fundamentally, that's what he said. So that we might as well use this assumption. And at a later point, about 4 years later, he wrote a paper saying, if we don't have the same expectations, and then quote unquote from this paper, the theory is in a shambles. There's no market line. The whole thing collapses.
Right.
It's not linear at some places, non-linear at others. The whole theory goes out the window. So this assumption is false.
Well, who's using it? How is it used today?
It's the foundation of financial management because people go through university courses and learn this garbage, and then what they get taught is the only thing that people can differ on is their risk profile. So the only question you have to ask people is how much risk are you willing to take on, and then we'll work out a portfolio for you based on that risk combination. That's the only way you can differ. Now, this is why when the financial crisis hit, they didn't have a damn clue that it was coming, because the theory wasn't only that people have the same expectations, it also had to be that their expectations were correct. And this was stated in a paper by Fama and French, I think that was in 2004, where they empirically examined the capital asset market line theory over time and found it completely and abjectly fails and should not be used. So Fama and French, and Fama played the major role in promoting this stuff back in the 50s, that's how he made his career, comes out and says you shouldn't use the theory. It's empirically false.
So when your advisor says, okay, do you want low risk, medium risk or high risk? That makes no difference.
They are simply channeling a theory which is false.
Right.
And then they're getting put into the stuff and saying this is going to work out nicely for you in the future. No, it won't, because the foundation of the theory is completely wrong.
But if I take the low risk, they are going to put it into
bonds.
Close to that, into bonds.
Yeah, bonds.
Exactly.
Yeah. So, but it's the foundation of finance theory is rotten.
Yeah,
and
government bonds in particular.
Yeah, government bonds in particular.
Yeah. All right, number 3. Mm-hmm. Climate change, your favourite one. This idea, and I guess, I mean, economists are playing a lot in this space, aren't they now? It's almost like they're operating like, let's do a cost-benefit analysis on.
That's exactly what they're doing.
And and the danger of that, of course, is that they say, well, okay, once we put figures in it, we may discover that it's actually really not worth doing anything at all because it's going to cost too much. The societal cost of trying to save the future is going to be so large. The cost-benefit analysis is showing it's not worth us doing anything.
Yep, that's pretty much a dinosaur calculation, which is what they've done.
Right.
They've basically said, and like Nordhaus's, if people look at Nordhaus's Nobel Prize speech, which they can find online, and the PDF of it, he has a chart showing that if you attempt to reduce climate change to the level of damage expected, the 1.5 degree target that Extinction Rebellion has set, that is going to cost about $50 billion, and the benefit will be about $3 billion. So you lose $47 billion, roughly, in current dollars, to try to save the climate in the future. So it's not worth doing it. And the best situation is, in his Nobel Prize speech, was to let temperature rise by 4 degrees, which will only cause $16 billion worth of damages and cost us about $3 billion to fix.
Well, there we are. From an economic point of view, that's fine. Human loss of life, obviously, or the
human extinction. It's a minor cost, really, because
so long as the economy's fine,
the economy is going to be fine.
But that is the problem, isn't it? Because the moment you start looking at it on a cost-benefit basis, then the charges that you incur now might be horrendous. But the fact that they are horrendous really says that's because something's happening here. It's a big deal.
So I haven't published this one yet, but I'm going through Nordhaus's so-called enumeration method that he tried to work out the damages from climate change. And even the graph he drew shows his bias in the first place, because his graph for the cost of climate change just goes exponential. If you try to get to 100% mitigation, which in other words mean temperature remains at pre-industrial levels, then before you get there, he's got infinite cost.
No.
That's in his mind.
Well, that might be because it's unachievable.
It's not necessarily infinite. It would be a finite cost.
Yeah, but it would be enormous but finite.
Enormous but finite.
Yeah.
But when he draws the benefits of it, which is what are the negatives from climate change, he draws a wavy line, which is pretty much a straight line, just with little wiggles on it. And at 0% abatement, it's got a finite cost. And in this first paper, he estimated that finite cost of a 3-degree increase in temperature as 1/4 of 1% of GDP. 1/4 of 1%.
That's right. That's not the cost of stopping that happening.
That's what would happen if we do nothing.
Right. Okay.
1/4 of 1%. And you then
the impact on the economy.
Impact of the global economy, and not in terms of discounted from the future. That's the difference. GDP in 2050, which is what he's working with his first paper. GDP in 2050 would be 1/4 of 1% lower than it would be in the total absence of climate change. So
it's really sort of comparable with, what some people would say is going to be the impact of Brexit or the
Brexit's
US.
Huge by comparison to that.
It's crazy.
This is rounding error.
Yeah.
1/4 of 1% is the state level at which they revise annual GDP.
So how does he win a Nobel Prize? That's
because economists are reading his garbage.
Right.
And economists live in garbage, and they can't tell garbage from garbage.
So how should we be if the idea of a cost-benefit analysis is it the wrong approach or is it the right approach? It's just having the wrong numbers.
It's the wrong approach, period. Right. There's no way that you can consider an existential threat with cost-benefit. just to give you an idea of why, imagine that Winston Churchill, rather than saying we shall fight them on the beaches.
Yeah, let's do it. We shall do a cost-benefit analysis and decide whether we will fight them on the beach.
And the cost-benefit analysis would have said, not worth it.
Yeah.
The cost of the Germans taking over the economy is maybe 1/4%.
Yeah.
In fact, the level of spending in the 1940
might actually have come out as a benefit to do nothing at all. We might have thought
where did they come from?
Rise of British manufacturing. We could be so much better off, couldn't we?
Look how industrialised we'd be. A few less of us, if you people didn't need climate change to get hot. But literally, that was the sort of... You do not use cost-benefit for an existential threat.
Right. Number 4, diminishing marginal productivity. So this sort of makes sense, doesn't it? If I'm a farmer and I'm using my most arable land to grow crops, I'm going to come to a point, obviously, where demand is so high. I've used all those fields. I've got to use the less arable fields, but still the same number of workers. So I'm going to get a diminishing return based on that increased demand. That makes sense, doesn't it?
Now, mate, I'm almost about to give you a Nobel Prize, and a genuine one, because what you've actually stated there is Ricardo's theory of diminishing returns, which is valid.
Yeah.
Okay. Because what Ricardo said...
I don't get it when he goes to the next stage, which is to say, well, actually, you're going to get to a point where your output actually decreases as you...
Well, no, Ricardo's idea made sense in Ricardo's intellectual framework, and that was that you start farming on the best possible land, and then as the need for more output forces you to produce on less arable land, you get a lower output.
Yeah.
And that was his theory of rent. So he said rent is actually the differential between the worst land being used and the best land being used, so that the yield is the same for the farmer and the landlord gets the rent difference. That's his theory of rent. So that's actually diminishing productivity because you're using less productive land. And that's a valid concept. What the neoclassicals did was diminishing. That's a cool idea. Let's assume that it applies to production where there's no change in the quality of inputs. So you have uniform quality labour and uniform quality capital, and we want to get the same result as Ricardo.
Yeah.
So how do we
So to use your technical jargon, that is bullshit, isn't it?
It's bullshit, yeah. What they did was they assumed that your example of a field is perfectly accurate. Okay, that's the way it should be used. So I'm going to use another example and say you've got perfectly uniform land quality and you're putting fertiliser on that land. Okay, it's the fertiliser you're adding. And there's some ideal amount of fertiliser per hectare that you should do. Let's just say it's a kilo per square metre.
Yeah.
Okay, that's the perfect amount of fertiliser to place, and you've got a square kilometre, 1,000 metres. Okay?
Yeah.
Okay. So, and there's the ideal ratio is 1 kilo per metre, square metre. You've only got 1 kilo of fertiliser. What do you do according to neoclassical theory? You spread the 1 kilo over the whole 1,000 square metres.
Rather than just taking the 1 square metre.
And putting it properly there. A sensible farmer just puts the fertiliser on
where it's going to work.
Where it's going to work.
Yeah.
Now, their theory assumes you spread over the whole damn lot. In terms of a factory, what it assumes is you've got a factory with 10 production lines. You've only got enough workers to properly staff one of the production lines. You spread those workers over the whole 10 lines.
Right. With all the costs of running all of those production lines, even though...
So Sraffa made this point. P.R. Sraffa back in the 1920s, one of the greatest economists, massively neglected. He said, well, that's just nonsense. A proper industrialist would use capital and labour in the ideal ratio and leave the capital idle until demand rose sufficiently that it was worth the while to use more capital and labour in their perfect ratio. And only once you got to the full capacity of the factory would you start to have problems. And at that stage, you should have built a new factory for investment reasons. So what you'll get is a constant return. You will not get diminishing return. That was his logical argument back in 1926.
Right. Okay. Unless you're using a resource which is finite. Unless you've...
Well, there's no such thing as finite resources. There's scarce resources, but they're not finite. And I go back to the previous fucking aside. Pardon me. Can you cut that word out, please? I shouldn't use it.
No. It's in there. No, this
there you go. There you go.
It's too close to Christmas. I'm not editing this at all. Not for kids.
Not for kids. Okay. So then when a group called the Oxford Research Group of economists back in, and did you see that chart a couple of days ago showing that every prime minister for the last 50 years or 60 years, 70 years has come from Oxford, with the exception of those who didn't go to university at all, which included Winston Churchill. Everybody else is Oxford.
Yeah.
Anyway, so what the Oxford...
I think half of them went to Eton, didn't they, as well?
Yeah. So the Oxford study group was formed by a bunch of economists to go and try to have an interface with business people and bring theory and practice together. And they had this first meeting, and the businessmen were just shaking their heads and scratching and saying, "What are you talking about? We don't. That's not how we produce in a factory. That's not what we do." So they decided to go and do some research and see how many firms had diminishing marginal productivity, which in the textbooks is shown as rising marginal cost. And rising marginal cost is what gives you the upward sloping supply curve. They found 95% of the firms said, no, we have constant or falling marginal cost. The reason being, if you start off with a factory where we're only using one line and you've got 10, and you've got all the various air conditioning units and heating, blah, 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 as you expand, you've designed the factory to work best as maximum capacity. So as you start getting closer to maximum capacity, your cost per unit are falling. And at the same time, you have huge fixed costs to build the factory in the first place. Necessarily, fixed cost per unit fall as you produce more units.
Yeah.
So you have diminishing costs from the fixed cost, and you have constant or falling costs from the variable costs. You do not get diminishing marginal productivity. You don't get a rising supply curve.
So how do conventional economists argue then the difference between this diminishing marginal productivity and economies of scale? They're at odds with each other.
Economies of scale, they put in another bracket. So they say, like, they talk about
up to a point. Yeah. It's economies of scale up to the point where you start to get diminishing marginal productivity.
I mean, even with long-term stuff, they'll draw curves with falling and then rising long-term average cost curves. Students will go through doing this exercise of the two. Even they don't work out intellectually properly. So they want to talk about economies of scale that occur within a firm but not between firms. It's a complicated mess. We might leave that one for another podcast.
All right. But out of all of this, so, I mean, we've debunked four.
One more to go.
One more to go. Yes, sorry, the final one.
Yeah, the biggest one.
Which relates to all of these, though, doesn't it?
It is when your conclusions depend upon your assumption, and if your assumption's wrong, your conclusions are wrong.
Yeah.
That's not a simplifying assumption.
Right.
It's a fantasy.
So that is number 5.
That is the key one.
Economists are simplifying assumptions. That's the issue.
They call them simplifying assumptions. They're, in fact, assumptions on which the conclusions depend.
Yeah.
Now, a simplifying assumption...
Garbage in, garbage out.
Well, yeah, but it's like a simplifying assumption is to assume, for example, that there's no topography between London and Farnham for the train. So you show a train map with no question about the topography. If you included the topography on the map, it'd be harder to read, but it would still work. Okay? That is a simplifying assumption.
It wouldn't be far wrong. It is pretty flat between London and Farnham.
It is pretty flat, yeah. But like, for example, the tube map. And I see a whole lot of LSE economists making this claim all the time. Our assumptions are like the tube map. The tube map distorts the distances between stations, but you can still use the map to navigate, which is true. Now, if you put the accurate distance, the map would be less useful, but you could still use the map to navigate.
Well, and it does distort behaviour. I mean, I've seen studies showing that, in fact, people get the tube, even though the walking distance is shorter, because the tube map makes it look further.
Yeah, that can happen.
But it does distort behaviour because it's
slightly,
inaccurate.
But it's an inaccuracy we can live with. If you're modifying it to make the map accurate, that would just make the map harder to read.
Yeah.
But it would still correctly tell you how to get around London.
Metro, anyway.
So that is a simplifying assumption. These are fantasies. These are fantasies which, if they're false, the theory is wrong. And Sharp admitted, they said the theory is in a shambles. So they use what a brilliant philosopher of science, Alan Musgrave, called domain assumptions as simplifying assumptions. And domain assumptions say, if this assumption applies, then your theory works.
Right.
If the assumption doesn't apply, your theory doesn't apply either.
So it's like saying, okay, well, we've got a theory here which we'd like to implement, but the problem is there's one or two inconvenient things here that stop it working, so let's just tell ourselves that they don't exist, even though they're part of the real world.
Get them rid of it. So, my favourite was that in the financial crisis, because one of their assumptions is rational behaviour. And I've got this is where my favourite cameo comes in this. I gave a seminar. I spoke at the Western Economic Association conference when they held it in Brisbane once, and a whole bunch of American neoclassicals came out for the conference, a bit of a holiday in Australia as well. And I went to one seminar, and there's this young, obviously totally off with the fairies, addicted to neoclassical thought, very voluble, bubbly young PhD, so maybe 28, 30. And I thought, he's explaining his model and he's having a great time explaining it. And I thought, if he comes to my seminar, there's going to be real fun, which he did. And he sat in the front row. And I could just, as I was explaining my Minsky theory, my model of Minsky's financial instability hypothesis, he was getting more and more agitated. And I was watching him. And I thought, he's going to say something soon. And he finally blurted out, and literally this is how he said it, but you're assuming everybody's an idiot. And I said, well, did you see the financial crisis coming? And he said, no. And I said, well, on that basis, on your own assumption, you're an idiot. Why shouldn't I imagine the world consists of people like you? I was actually, I realised how rude I was being and actually held back from saying
it. Do you have trouble making friends, Steve?
I have, it's one of my problems.
Maybe we can work on that.
Yeah. But anyway, he followed me out of the room afterwards and he finally says to me, but we have to make some simplifying assumptions. I said over the back of my shoulder, there was no point talking to him face to face. I said, mate, you've got to learn the difference between a simplifying assumption and a fantasy.
So, I mean, they're part and parcel of the same thing, though, aren't they? Simplifying assumptions and models which oversimplify things. And all of this obviously leads towards your work, which is to say, well, actually, the whole thing is far more complicated than that. We've got to include the real world in all of this. We can't make these assumptions. Well, these models don't work. But
you've got to work in the opposite direction. If they try to build macro from micro. The first one we went through with Gorman and Samuelson shows you can't do that. You cannot derive even a market demand curve from microeconomics. The second one says that the supply curve is wrong at the very micro level. That's not how individual firms behave anyway. The stuff over climate change, you cannot assume that the GDP temperature differences that apply on the planet today can predict the impact of increasing temperature by 10 degrees, which is what they do. You've seen my fight with Toll on that front. And the stock market thing, literally, when Fama wrote back saying, not only was Sharpe's assumption that we don't disagree, that we all agree on the prospects, this is the right assumption. That is what's going to happen. So are there any laws? I mean, in other brands of real science, we can say, well, we're pretty certain on gravity. We've been observing that until we see something rising. Without explanation, we know gravity works. Is there any law like that we can apply in economics? Or does economics have no law? In mainstream economics, none. That's actually a very interesting question. I'm struggling to think of anything that is called a law that actually applies in reality in economics, like the law of one price, for example, that's violated across the planet. No. What I'm trying to do is go the opposite direction.
It's not a science then, is it really?
It's not a science, it's a mythology, it's a fantasy. But what I'm trying to do is go the opposite direction. So in my most recent paper, I said you can drive macro from micro. Macro from macro itself. If you started the definition of the level of employment and the wages share of GDP and the debt level, you can derive a model with very simple assumptions about behaviour which give you the characteristics we saw of the financial crisis, the great moderation first, a crisis after, rising inequality. That does all come out of that model. So it's possible to start working that way. What I've done with energy, the same story. If you include energy in production, then you have a link between the laws of thermodynamics, and they are incontrovertible laws, and economics can be derived that way. But where we stand at the moment, it's just as bad as before Copernicus. We have a bunch of Ptolemaic economists with epicycles and equants and so on and so forth, and an earth-centered stable equilibrium vision. That's what we exist as. So just as there was no laws of astronomy before Copernicus, there are no laws of economics with neoclassical economics.
So we should be burning our economics textbooks and starting again. Is that what you're saying? There's nothing of merit in any work that's been published?
I think it's probably better to put them in the field and compost them and turn them into peat.
Right. And see what return you get from that.
Yeah.
Don't spread them too thinly on the field, though.
No, that won't work. Little visual location, yeah.
Good to talk, Steve. And look, if you're listening to this before Christmas, have a good Christmas.
Yeah, and we might even make this the one for the public and Christmas present number.
Well,
yeah,
that would be very generous of us. Let's do that. All right, good to talk, Steve. We'll see you again soon. You got to love these instantaneous pricing decisions, haven't you? That's it for today. Next week, well, we're taking a bit of a break, depending on when you're listening to this, but we're going to skip a week for Christmas and all. But our first week back in the new year, we're going to look at our predictions, or Steve's predictions, more to the point, for 2020. Will it be better than 2019, or are we going down a downward spiral and things are only going to get worse? We'll find out. It all depends on what sort of mood he's in. That's next time on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. We'll see you then. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.